Happy Friday, everybody. Good to be here. My name is Brent Morse. Condors, calendars, and butterflies. We're going to hit one of those topics today. Specifically, we're going to hit up calendars. Last couple of weeks, we've hit up condors in different ways, and today, calendar spreads. So we'll get to that in just a minute. I'm joined by James Boyd in the chat, helping me out. Appreciate James. And encourage each of you to check out James's Investing Master series on Tuesdays at 11 o'clock Eastern Time. And I also encourage you to check out our Managing Your Options Portfolio webcast, which occurs on Wednesdays at noon Eastern Time, where we manage various trades, including some of the main trades that we place in this class here. But you can follow James or myself on X at BrentMooreCS, at James Boyd CS, and familiar names in the chat. Appreciate you joining me today, and some unfamiliar names in the chat too. Glad to have you here as well. And if you're watching on a recording, that's just fine. Hey, let's go through the disclosures here real quick. Options do carry a high level of risk and are not suitable for all investors. And the material today is intended for general informational purposes and educational purposes only. This is not an individual recommendation or personalized investment advice. Short options can be assigned at any time up to expiration, including regardless of the in-the-money amount. The paper money software application is provided for educational purposes only. Paper money virtual trading application will not assign short options early. That's different than a real trading account. And that's pertinent here because we're going to be dealing with short options in this class today. All investing involves real risk, including loss of principal. And past performance is no guarantee of future results. And there you go. Hey, let's start off. Let's head on over to the Thinkorswim platform. And let me just, actually, you know what? Let me just mention this let's start off with this here. We'll start off. Here's the markets. Hey, we had a nice bounce up. We had CPI data come out today. It was kind of important in the sense that we haven't had a lot of data lately because of the government shutdown. And so when we do get data, hey, thanks. Sorry about the little interruption there. Hey, we are back. I was just saying when I got cut off, the inflation picture is a little mixed right now, but the print that came out this morning was actually a pretty positive one. And hey, the market's reacting positively. But you know what? Hey, we've had good data, we've had bad data. The trend has continued up regardless. And there we go. So let's look at a trade. Let's look at a potential trade because we have a lot of stocks that are heading up. And let's look at FCX right now. Okay. Because a lot of stocks you're going to find are a little bit more neutral, and that fits that calendar spread, which is a neutral type trade. Calendar spreads are neutral-ish trades. We can skew them a little bullish, we can skew them a little bearish, but for the most part, there are trades you're doing as more of a neutral type trade. Now, and one reason is if you're very bullish, your gains are going to be very limited on a calendar spread as opposed to a trade that's just more bullish, maybe buying the stock, maybe doing a long option, buying a long call. So find stocks that you deem to be more neutral. What stocks do you deem to be more neutral? Everybody's different on that, but I just wanted to give you an example of some of the things that maybe we'd look for on this. Number one, trend. Look, I have a 20-day moving average and I have a 50-day moving average here. You can see those, by the way, when you're watching a webcast and you're going, what are those moving averages there? Kind of look at the top of the screen and often you can see them right there. It's a 20 and 50-day moving average. What are they doing? Are they showing signs of a strong trend? And if the answer is yes, then a calendar spread may not be the best trade to do at that point, unless you think that trend is going to come to an end. But one of the principles of technical analysis is what we've seen over the past is we're going to kind of continue with that. Same thing in terms of support and resistance, okay? If I find a stock that has kind of defined resistance levels. Well, that seems like that may be a resistance level. This may be kind of a resistance there. And oh, here's a support, and maybe even a little bit one shorter term right there. So kind of some impediments to the upside, some impediments to the downside. That would be another thing that may help. A channeling type stock may help. Those are kind of the first two things that come to mind here. Now, you can do other things. You can look at momentum indicators and stuff, but just realize there's a difference between shorter term momentum and intermediate term trends there. Okay. In the chat said, I look for stocks with low ADX. Well, ADX is a trending indicator. The higher the number on the ADX, the stronger the trend is, whether it's to the upside or the downside there. Okay, that'd be an example there. So something more neutral. Now, let me go back to that moving average thing for a sec here, because I have a 20 and a 50-day moving average. Let's say you're using shorter term moving averages. Can you do that? Here's a 10-day EMA, which is a pretty quick moving average, a 10-day exponential moving average. And you can see that in the red. And you can always tell, you have a good idea of how quick the moving average is by how tightly it hugs the price data and changes in the price data. Okay? And so you can see this red moving average is hugging that data pretty tightly. It's pretty tight. But what's it doing? It's basically flat right now. Yeah, the 30 days been going down a little bit, but all in all, I think the picture is a little bit more neutral. So that's why what I'm saying from a technical standpoint is we should be, the approach I'm going to take is more of a neutral trade on FCX. Now, there are other indicators you can do too. One that I often use, you guys, if you've watched me in the past, you've seen me use it before, the volume profile. What does the volume profile do? It just tells you where the stock, what prices that stock is traded at. Okay? Of course, it's traded at all these prices, but where's it traded at the most? The ones with the highest volume. So when you see this is kind of this, I guess we call it trimodal maybe, like this. The stock, in theory, tends to trade more at these higher areas right here. So so it's more likely that perhaps if you're going to use this volume profile to trade in this area, more of a neutral forecaster. So that let's take a look. I'm going to take this off the screen just to kind of clear up the screen just a little bit here, and let's look at a more of a neutral type trade. With calendar spreads, we're buying a contract and we're selling a contract. Typically what we're buying and selling is for our rules in this webcast, we're going to go out 20, 30 days maybe on the short contract, and maybe something closer to 50 days on the long contract. So let's do it. Let me go out. I'll go out 21. We'll go out to the monthly contracts here. Let's go to 28 days on the short contract. And I'm going to look to sell this. And I'm going to say this is going to be pretty neutral here. I'm going to go to, say, maybe the 42 contract. And I'm going to look to sell that one. I'm going to click on the calls. Why the calls? Because that's out of the money right now. If I think the stock is going to go down, and if I think the stock is going to go down in price, then I may do put calendars. You can do call calendars or put calendars. There's not a huge difference between the two. One benefit, if you think the stock is going to inch its way down, is that implied volatilities, when stocks go down, tend to go up, and this is a positive Vega trade. And so if you think it's going to go down a little bit, that may help you a little bit on that. But the problem, if I think, well, I think this stock is going to go, I'm not going to do a $41 calendar spread right now when the stock is at $41.50, because then it's in the money. And remember, you have higher assignment risk if you're in the money. All right, so let's do this. Let's look at the 42. I'm going to sell this one just by simply clicking on it. Okay. I clicked on that. Let me go out. I'm going to go out to about 50 days or so. Let's go up to December 19th. I'm going to go out to the 42 contract, same contract, and I'm going to control click on it. That brings up a calendar spread. By definition, on a calendar spread, same strike. Both of those, same strike. One's long, one's short. Do they just offset each other completely? No, they don't offset each other completely. Look at this. Let me pull up our theta. Here's my theta on my November contract. 4 cents a day, or $4 a day if you use your $100 multiplier. The long contract, $2 a day. There's a difference between those. That's one of the principal reasons why people use calendar spreads, because this is the short contract. This is the one where the time decay is helping us out. The higher value is where the time decay is helping us out. The lower value is where the time decay works against us. There's a net difference, and of course there's a rounding error we may be looking at here, but of 0.02, or basically a couple dollars a day, which doesn't sound like much, and it's not a lot, but day after day after day on a contract that tend to be slower moving trades, that can add up. That's one of the reasons why people do calendar spreads. Let's think of it for another way. Let's look at this another way. I'm going to go to the Theo price here, and I'm going to say the stock stays basically where it's at. Okay, so I'm not going to change the stock price here on this, but I'm going to go to that first month expiration, November 21st. Let's go to November 21st on this and just look and see what we got. Here's November 21st. Let's look at the price of that short option. The price of the short option is basically going to be 0 if the stock stays where it is right now. Okay. The price of the long contract, it's going to go down a little bit. It's going to go down from about a little under $250, somewhere in there, to about $165. So we lose, I don't know, $80 on the long contract in that case. But you know what? We gain $170 on the short contract. That's the differential on those. That's where why they're neutral trades. Now, this can go up a little bit or down a little bit, and it'll still be okay. We don't want it to move that much there on us. Okay. Now, while we're here on this particular trade we're looking at, let's look at Vega, because I said they're Vega positive trades. Here's the Vega. There is a little difference between these contracts, and the short contract's going to be Vega negative. The long contract's going to be Vega positive, and overall it's a positive Vega trade. But the thing is this, we don't know what Vega is going to do. We don't know what implied volatility is going to do. We know time's going to tick away. So the theta is kind of a key thing here. But if we think implied volatilities are going to be going up, then a calendar spread may make sense from that standpoint. Okay? I'm hoping that makes sense there. So do I want it to be in the money or out of the money? I'm going to go out of the money on these in general, or right at the money. Okay? If we're totally neutral on this, then we may go right at the money, because the odds of getting assigned early, if we're kind of at the money, are pretty low. As you get closer to expiration, the more in the money you go, the higher the chance of early assignment. As you get fewer days to go till expiration, the higher the chance of early assignment. Okay? So typically we're going to go a little bit out of the money on those. Okay? I'm hoping that answers your question there, Chris. So let's take a look at this trade here. So that's the trade, and I'm going to do some. I'm going to increase the number of contracts here just a little bit, and I'm just going to analyze this real quick and take a look at this. Okay, so that's not what I want. I want this. Here we go. This is what it looks like. This is what the trade looks like right here. This is profit or loss. Profit, 100, 200, 300, 400, 500. This is loss, okay? This is as it goes against us. Notice the profit peaks out at a very particular price. Well, that price, not coincidentally here, is the strike prices we chose. We want the stock to be where the strike price is. So if we're more bullish on this, maybe we do the 43 or 44 strike instead of the 42 strike. Or if we're more bearish, maybe we do the 40 or 39. But that's in terms of your strike selection, you pick the strike where you think the stock is more likely to go. Okay, more likely to go. Now, I don't want you to concern yourself too much about the max gain here. That max gain actually looks pretty good. It's almost $500 there on that, it looks like. And it's better than the max loss, no doubt. But the thing is, what are the odds we're going to hit this exactly at expiration? The answer is probably not. So we're not going to wait all the way till expiration. Number one, the odds of early assignment go up. Number two, your gamma goes up near expiration, so it can swing from very good to very bad very quickly. And realistically, we're not going to likely to hit this point exactly anyway. So if we can get 25%, maybe 50% of our max gain, somewhere in there, 25 to 50% of the max gain, often we'll look to exit out, okay? We'll get out. So there we go. That's going to be one of our exit rules. If things are going well and we have, I don't know, 25%, 30%, 40% maybe, we're probably just going to take the gains on that. That's going to be one of our management rules on that. Another management rule, what if things start going completely sideways or down on us or up on us, because it's bad scenario if it goes way up, bad scenario if it goes way down. What if we start breaking support levels and resistance levels? Well, we may look to get out then. If our neutral trade turns bullish or our neutral trade turns bearish, then we're going to look to get out on that one too. And then finally, we're not going to wait all the way to expiration. Even if things are going kind of okay or not great, but not terrible, about a week to go to expiration, we're going to look to get out of that trade. Let's place that trade. Let me go back to the trade tab. Let's just click on confirm and send and take a look at this. Here's what we got. I'm buying a calendar. We talked about the forecast. We want it to be neutral. We talked about the expiration dates. Here, about 20, 30 days out, about 50 or so days out is kind of a standard one we'll do. We can tweak it a little bit. And then we talked about exits. If things are going well, if things are going poorly, if things are kind of going sideways, we're going to look to get out. But here's the big caveat. These trades are slow-moving trades typically. If you're getting these and you're expecting a big move quickly, it's kind of like iron condors in that sense. Typically, they just don't go very, very far, very quick. Let's throw that in the calendars bucket here on that, and we just added a calendar to our portfolio there. Okay. Now, as you have questions, feel free to type those in. So Chris says, yep. Chris says, when are we going to get out if things are going well? We're not going to wait. We're not going to try and get that 100%. You're not going to, let's just be honest right now. That risk profile, it looks kind of like this, kind of like a tent or something like that. You're not going to hit that. It's just not. I mean, it just seems really unlikely. So So we're not going to bank on that here. Okay. Other aspects of the trade that I want to talk about here. Let me get rid of my little drawing tool. And let's look at another, maybe kind of neutralish one. Maybe. You judge. You tell me. What do you think? I'm going to call that kind of neutral. Okay. We talked about the expirations you pick, the strike prices, wherever you think the stock is going to go. And that's one place where like volume profile may help you out, is you can go here, add that volume profile, and you go, well, where do I'm thinking it's going to go down kind of in that 29 range maybe. Okay. So I'm going to look for that 29 strike there. We talked about positive theta, positive vega. It's not typically a super high probability trade, but yes, you can potentially gain more than you lose on that. And we're not going to we're going to try and get out before we lose the full amount anyway. We're going to try and avoid the max loss. If you get out of the trade, again, 10 days, a week or so before expiration, the vast majority of time you will avoid a max loss on that trade. The max loss on the trade is going to be your initial debit. Okay? So, there we go. Money management. To look at your max loss, maybe 1 to 2% of your max loss. Now let's talk about volatility and earnings and whatnot. On Carnival here, I have earnings coming out on December 18th. So let's say we do a trade, okay? In fact, let me go back real quick to FCX here again. Let's look at that FCX. When's our earnings? Our earnings on FCX is out here in January. In general, what happens to implied volatilities when earnings comes out? Typically, they kind of go up and then drop off with earnings. Okay, that's a kind of an exaggeration on it. I kind of overly did it because it doesn't go, nice and smoothly up necessarily, and it doesn't just initially drop all the way down necessarily to the full level. But that's typically what we see. You'll notice today I'm avoiding earnings. What about calendars over earnings? You can do them. Stay tuned for next week. We'll talk about doing calendars over earnings next week. But remember, this is a positive vega trade. We benefit with these as implied volatilities go up. Now, I can't guarantee they're going to go up. I don't know. But that's kind of the theory, is before earnings, they're going to tend to go up here. So let me go here. And you can pull up your implied volatility. And after earnings, we just dropped down. And you can see this one, after earnings last time, it kind of was steady for a little bit, and then it started its climb up. This may be steady for a little bit and then start its climb up. Who knows? But it would benefit us if that implied volatility goes up for that. Okay, let's go back to the trade, our next trade. Carnival. Okay. Here we go. What happened after earnings? Implied volatility dropped. Maybe starting to creep up a little bit. That's beneficial to us in that case. You are not stuck, though, with 20 days, 20 to 40 days short contract, 50 to 70 days long contract. You can change time frames. Let's do it on this one. But let me first look at, we already looked at it briefly. We said, in terms of picking a strike price, I'm going to pick a strike that's where I think the stock is going to go. I'm just going to take the highest volume profile, which is right around 29 bucks. We're a little bit above 29 bucks. I'm going to do this out of the money. Okay? So are we doing calls or puts here? If I'm going to do it out of the money. Let me go to the trade tab. Here's CCL. Okay. I'm going to go a little shorter term here on this. Can we go real short term? Yeah, we can go real short. I mean, you can go out a week if you want on this. There's October 31st. Let's go 2 weeks, okay? I'm going to go 2 weeks out on this. And I'm going to look. Now, one thing you want to be careful on is liquidity. We talk about this each week. Watch about liquidity. You can go to open interest and look at your open interest here on this. Not huge open interest. I've got 3,500 at the 29 strike, but let's look at the bid-ask spread, about 5 cents. That's fine. I'm going to look at that 29 put there. I'm going to look at that 29 put. So let me go and let me go out, and I want to give it a little time here. We'll go out, see if we have the same strike. Sometimes when you go from weeklies to monthlies, you don't have the same strike. 29, about a 5 cent bid-ask spread. Okay, that seems reasonable. So here's what we're going to do. We're going to sell this one. We're going to go to 29. We're going to buy this one. I'm holding down my control key, by the way, on that, so I don't just overwrite the first one. So max loss, 33 bucks. Okay, you go, well, that's not much money. That's fine. Well, we may do more than one contract. Also, if my max loss is 33 bucks, my max gain may not be super spectacularly high either. So, but let's view it. Okay, let's view it. So I'm going to analyze, right click on it, analyze trade. Here we go. So well, that's what it looks like, right? Here's our current stock price right here. Are we bullish or bearish? I said they're neutral trades. Well, neutral's fine. A little bearish, okay? This means our delta is going to be a little bit negative. It benefits us if it goes down a little bit, which was our forecast, for it to go down a little bit there on that. But you can see how you can skew these more bullish or more bearish. If I decide to, is it going to let me do this? Hold on one sec. Let me scroll down. If I decide to make this 30 instead of 29, now I've made it more bullish. You see, I benefit, my delta turns positive in this case. But in this case, I'm not going to do that. I'm going to stick with the 29. There we go. Delta, negative. Theta, positive. Vega, positive. We already knew that though. So let's keep on going. There's the trade. Now, short-term trade. Can I say, well, what if it goes against me? I want to get out of this. Well, you can do that, and we can put in an order to exit early if we want. Generally, these are slower moving trades, so it may not be as incumbent to put that automatic exit in. Our reward to risk ratio, it's going to be positive if we were to take the max gain, which is up here, and our max loss, which is down. Remember, our max loss was going to be 33. It's right off the edge of my screen there. $33 max loss. My max gain is up above 50 bucks. Okay, but again, we're going to just take a fraction of that level. So let's go and put in let's look at exit points on this. Let me go to the chart. Let me get out of, well, let's do this. Let's say, let me do this. And let's just kind of look at areas where maybe there's some support around here. Would you agree with me on that? That maybe there's some support around there, around the $28 level? Okay. Maybe there's some resistance up here around the $32 level. Now let's look back at that chart here. 32. Now, if it goes to 32, am I in a terrible situation? Probably, this is a limited loss trade. Also, it depends on when it goes to 32. Remember, if the stock, as time goes, this purple line is going to kind of morph into this blue line. Okay? The purple line is going to kind of morph into this blue line. And it's going to go down. Okay? In other words, that the loss gets worse as time goes on. This portion of the graph right here is a negative theta portion of the graph. This portion over here is a negative theta portion of the trade graph. Where we're at, and in here, it's positive theta. Time decay helps us out. Okay. So Chuck says, why would I do this type of trade other types? Well, I do this trade if I'm neutral. I do this trade if I want positive theta. I do this trade if I want positive vega. So if you think about it and you compare it to, say, an iron condor trade, let's think about a calendar spread versus an iron condor. They're both kind of neutral-ish. Okay, they're both kind of neutral-ish. They both are positive theta. Time decay benefits you on both of those. One of them's positive vega, one of them's negative vega. So there's sometimes there's kind of a little bit subtle, and it's not like there's one right trade and one wrong trade necessarily, but it comes down to little things, and in this case, it likely may come down to vega on this. Now, this is a slower moving trade. It tends to, now what about a butterfly? A butterfly spread is similar in that regard. Butterfly spreads tend to be much lower probability than these. So, and in fact, practically for butterfly spreads, and you'll see this as we get more into butterflies and stuff, we end up skewing butterflies quite a bit. Okay. In other words, we'll differ the number of the width on the butterfly there. But this class isn't about butterflies right now. But so calendars, can we skew the calendar a little bit? Well, we can adjust strikes, like we said. We could change, instead of doing 229 strikes, 129 strike, 130 strike or something. At that point, it ceases to become a calendar spread. At that point, it's a diagonal spread. Okay? So let's keep on going. So I guess my point is, if things go south on us, the quicker they go south on us, the better, in the sense of we're less likely to be near a max loss in that case. Some traders use stop losses on these, some traders don't. You don't have to. But if we're going to say, well, if it's busting above 32, I'm done with this trade. Or if it's busting below 28, I'm done with that trade. If that's what you want, you can add in the trade. You go to put in your trade. You can do a first triggers sequential. You can right click on it, create an opposite order. When you create an opposite order, the contract that you bought up front, you're selling. The contract you sold up front, you're buying. It's going to have you get out of it. And in fact, let me do this. Let me go, and I'm going to just increase my number of contracts here. Just because, look, $35 risk isn't much. We can stand to risk a little bit more on this. How do I get out of this? Well, we said I jotted the prices down. What I did, 32.28. Okay, and may even go a little bit outside that. But what I'm going to do is I'm going to make sorry, this screen is scrunched down a little bit here. I'm going to make this a market order. I'm going to make it a good till canceled order. I'm going to click on the gear, and I'm going to say, look, if it marks less than, we said 28, I'll go 27.75. I'm going to get out. If it marks greater than or equal to, we said 32, I'll give it a little more wiggle room, 32.25, I'm going to get out of that trade. Save that, and then I can look to confirm and send that order. Okay. Now, let's say the stock hasn't gone against us completely. we're going to look to get out at a certain amount of time. In fact, we have a calendar spread in here. Let's look at, this is an older one. Oops. Come on. There we go. What do we got? There's Costco, okay? Costco, calendar spread, right? We've got a November 14th expiration and December 19th expiration. November 14th is a short contract, 21 days to go to expiration. Remember, these tend to be slower moving trades. I did two contracts on this, and you may be going, well, look, we're up $300 on this. That's not that slow moving. Well, it's an expensive stock. Most stocks aren't $930 stocks. When you get a $930 stock, I don't care what kind of option contract you're doing, it probably is going to affect that PL open more. The options are more expensive when you have more expensive stocks. If you do a long call, you're doing a bullish trade long call, and you do Costco, the long calls are going to tend to be more expensive calls. Same thing with puts. Same thing with whatever kind of trade. So don't get used to bigger numbers there, because unless you're doing more expensive contracts or you're doing a lot of contracts, you're probably not going to see big gains or big losses as quickly there. You know, there's always the potential for loss and risk, and you should be aware of what your initial debit is, because that's your max loss on that. Okay, assuming it doesn't go and you get assigned. You know, we can say, oh, this is my max loss on this. If you get assigned early on this, on a short call or short put, then you either have stock or short stock, and then the trade has changed and the whole risk configuration changes at that point. Okay? So there we go. But are we going to get out because of time? No, we said about a week to go till expiration. No, we got 21 days to go to expiration. Have we made most of what we can make on this? Well, let's take a look at that. We can use that Analyze tab on trades that we're already in. Here's Costco. Hold on one sec. Let me just go down here and see what we got. There we go. Okay. So it's changed. Look, we made $300. We still have a long ways we could potentially go on this trade right now. So I'm not gonna exit this right now on this. I'm gonna let that time decay work on us, because you know what? Everything else being equal, that's a big qualification. You know, everything else being equal, we're making 16, 17 bucks a day on the time decay component of this trade. Well, that adds up, you know, 1 day, 2 day, 3 day, a week, 2 weeks, 16, 17 bucks a day adds up on this. And so it can benefit us. Now, don't go trading this and going, well, that means I'm going to automatically make 16 bucks a day, because remember, you got a delta on this too. The stock can move against you, and you can lose more on the stock movement than you gain on the time decay on that. So just be a little cautious on that. Okay, so I'm not going to get out because of time. I'm not going to get out because we've made a lot. We're clearly doing okay, but have I changed? This is the last question would be for me. Have I changed my forecast on this? This was intended to be a kind of neutralist trade around the 940 strike. Well, let's see where we're at. Here's Costco. We'll let this load, and then we'll see if we think 940 seems reasonable. Does 940, here's 940 right here, right where my cursor is. Does that seem kind of a reasonable-ish? Yeah, I'm not particularly bearish, not particularly bullish here. Okay. Now, Hill O'Keefe says you can roll that forward. You can roll these. Okay, you can roll these. I can roll one benefit, and I'm going to finish with this. Okay, if I have 21 days to go to expiration on the short contract, and I have 28 days to go, say, for example, based on the long contract, can I roll Well, probably not really, because if I'm rolling the 21, and then I'm probably next one's 28. But here I have a full 25 days difference between those. I could roll this to a date that's roll the November into the December. I could do that. Maybe we'll take a look at that come Wednesday in our Managing an Options Portfolio webcast. Consider rolling this trade out between the two, because what's going to happen is if I roll this out, I can bring in a credit and kind of reduce the overall cost exposure on the trade. So Wiley said, go to about 35 days. Yeah, probably go to about 35 days. You just got to look and see what dates are available. But I would say my initial instinct, Wiley, is go halfway. Go halfway between the two. Because the bigger the gap of the roll between the 28 days and whatever you're rolling to, the bigger the credit you can bring in, because there's a difference, because there's more time in the 35-day contract than, say, a 28-day contract or something like that. So you're rolling, and that you're selling that for a bigger credit. Hoping that's making sense here. So we're going to sit tight on this. Maybe in Managing Options Portfolio, we'll consider rolling that on Wednesday. But that's it, everybody. That's calendar spread. That's basic calendar spreads. Next week, I'm planning on talking about, hey, we're in earnings season right now. If you go to that Market Watch tab and you look at all those companies coming up with earnings, some bigger names coming up with earnings, can you do calendars on those? Yeah, we can. Kind of a totally different approach to calendars. We'll hit that up. But in the meantime, hey, have a great weekend, everybody. Thanks for joining me today. Thanks, James, in the chat. Also, make sure you subscribe to that Trader Talks channel. That way you don't miss the webcast content that we have. We have a whole bunch of, I don't know how many classes we have. We have like 30 classes or something. Webcasts. Check them out. Just subscribe to the Trader Talks channel so you don't miss them. And make sure you follow James and I on X at Brentmore CS at James Boyd CS. Everybody, have a wonderful weekend, and we'll see you all same time next week. Bye-bye, everybody.